All right, let's dive into a strategic synthesis of Hindustan Aeronautics Limited, or HAL. We're looking at data as of February 2026, and believe me, this isn't just another company report. What we're really unpacking here is the story of a national champion at a massive, massive turning point in its history. So, what's the big story? At its very core, it's about HAL's strategic pivot. We are witnessing a huge, deliberate shift away from what the company used to be towards something way more ambitious. And this slide really nails that transformation. You see, for decades, HAL was known primarily as a maintenance, repair, and overhaul specialist, MRO for short. But now it's transforming into a global original equipment manufacturer, an OEM. The goal here is to stop just fixing things and start designing and building world-class, high-tech aerospace platforms, from the ground up. Okay, so what's the argument that HAL can actually pull this off? Let's start with the bull case. And honestly, it all comes down to one thing: sheer, overwhelming scale. We're talking about both its orders and its financial muscle. Just look at these numbers. They really put things into perspective. On one side, you've got an annual revenue of around 30,000 crore rupees. But on the other, a colossal order book of 2.5 trillion rupees. That's a backlog that's almost 7 times its annual revenue. Think about that. It gives the company a clear production runway all the way through 2032. And you better believe this demand is hitting the bottom line. The recent Q3 results for fiscal year 26, they showed net profit surging 30% year over year. But here's the really important part. The EBITDA margin expanded to 24.3%. So this isn't just growth for growth's sake, it's profitable growth. And it's being driven by that big strategic shift towards higher margin manufacturing. On top of that, the financial foundation is just rock solid. I mean, we're talking about a zero-debt company with a return on equity over 26%. That just towers above the industry average of 15%. And get this, thanks to advances from the Ministry of Defense, it actually operates on a negative working capital cycle. Now, a really key development here was HAL getting Maharatna status back in October 2024. And this isn't just some fancy title. It actually gives the board significant financial freedom to go after global ventures and exports. And we're already seeing this play out, with real concrete export targets being set up in markets like the Philippines and South America. But every story has two sides, so let's flip this and talk about the bear case. This is where all that optimism about a massive order book smacks right into the harsh realities of execution risk and a very fragile supply chain. And this chart right here, this shows you the stark reality. 180 Tejas Mk1A jets have been ordered, but as of March 2026, guess how many are actually ready for induction? Only 5. Now sure, there's a standoff over some waivers, but that number, it speaks for itself. This is the execution gap, all in a single snapshot. So why does that gap even exist? Well, this slide points to the core vulnerability: supply chain fragility. The company's dependency on imported General Electric F414 engines has created a major delay, causing a 2-year lag in deliveries. It's simple, right? If you can't get the engines, you can't build the planes. And that massive order book, it just risks stagnation. The market, of course, is watching this tension very closely. Right now, HAL is trading at a price-to-earnings ratio of 31. That is significantly above its historical average. So what does that mean? It means the market is pricing in what we call an execution premium. It's betting that HAL will solve these problems before it actually has. That high valuation assumes the execution gap is going to get closed. The big question is, how? Well, that brings us to what is arguably the single most important factor in this entire analysis. This is the one catalyst that could resolve the entire bull versus bear debate once and for all. We're talking about the GE F414 engine deal, which is expected to be signed by March 2026. And this is not just another import agreement. The key, the absolute game changer, is the unprecedented 80% transfer of technology. This deal is explicitly designed to solve that supply chain bottleneck we just talked about. It's about giving HAL the power to manufacture critical components and really master jet engine metallurgy in-house. This is about de-risking the entire production line and achieving true self-reliance. Okay, so let's recap. We have a massive order book on one hand versus a major execution risk on the other, with a single crucial technology deal hanging in the balance as the potential solution. Let's try and synthesize all this into a final outlook. The stock chart itself kind of tells the story of this uncertainty. What we're seeing here is what technical analysts call a symmetrical triangle forming. See how the price is consolidating into a tighter and tighter range? This pattern basically reflects a market that's in wait and watch mode. It's waiting for a definitive breakout, one way or the other, based on news about that tech transfer. So, after all that, what's the final verdict from our source material? Well, the needle is pointing to accumulate. The view is that HAL is a long-term compounder. The recommended action isn't to just rush in and buy, but to accumulate shares on any depths while, and this is the important part, very closely monitoring those crucial tech transfer timelines. And that leaves us with the ultimate question that really frames HAL's entire future. The orders are there, the finances are strong, but that execution risk is very real. So the question remains, will the mastery of jet engine technology finally be the catalyst that closes HAL's execution gap for good?